Usually when a publicly traded company reports its quarterly earnings, there is a very predictable script that everyone follows.
Right. It's basically a law of market physics at this point.
Exactly. I mean, you crush your internal estimates, you raise your financial guidance for the rest of the year, and you definitively prove that your hottest new product is actually generating real cash.
And your stock price goes up.
Yeah, it's basic cause and effect. But then you look at what happened on Wall Street this week. I'm talking specifically about April 24, 2026. And suddenly, that gravity it stops working entirely.
Oh, completely. What we saw is the absolute definition of a structural disconnect.
Right. We are looking at a post-earnings market breakdown that defies every basic rule we are taught about how markets are supposed to behave. And the company we are talking about here is ServiceNow.
Right. Which, for those of you following the enterprise software space, is the absolute darling of the industry.
Yeah, they really are. So they dropped their Q1 2026 numbers, and objectively speaking, they are spectacular. I mean, they beat the high end of their own guidance.
They raised the full-year outlook.
They proved that their artificial intelligence products are generating serious, quantifiable revenue, and Wall Street's reward for this flawless execution. The stock suffers its worst single-day drop in company history.
Yeah, it plunged nearly 18% to close around $84.78.
Just billions of dollars in market cap, vaporized in a matter of hours. So that is our mission for today's deep dive. We are going to dissect this massive contradiction.
Because it really left a lot of financial analysts staring at their terminal screens, genuinely trying to figure out if there was a typo in the press release.
It really did. So I am taking the bull case here. I'm going to walk you through why ServiceNow's fundamentals, and specifically their massive AI vision, have literally never been stronger.
And I am taking the bear case, because as pristine as those top-line numbers look to the untrained eye, well, the fine print of that earnings call reveals a lot of brutal margin pressures.
Right, and complex geopolitical headwinds.
Exactly, plus intense valuation risks that absolutely terrify the institutional money managers.
So to get to the bottom of this, we've pulled together a stack of heavy-hitting sources. We are parsing through the raw Q1 earnings transcripts. We've got deep financial analysis notes from Elliot's musings.
And we pulled market reaction data from TIKR and post-market breakdowns from FX leaders.
Right. So whether you are actively holding tech stocks, trying to figure out who is actually making money in this AI boom, or you're just insanely curious about how a company can do everything seemingly right and still lose 18% of its value in a single day, this deep dive is for you.
It really is a masterclass in reading between the lines of corporate finance because, the headline numbers rarely tell the whole story.
Well, let's start with those headline numbers anyway, because I really want to establish the raw, undeniable strength of what happened in Q1.
Sure, lay it out.
If you strip away the stock ticker for a second and just look at the business itself, it is an absolute powerhouse. Subscription revenue hit $3.67 billion.
Which is massive.
Right, that is up 22% year over year, or 19% if you factor in constant currency. They beat the high end of their own estimates.
And we should contextualize that for the listener. For a software company operating at a multi-billion-dollar scale, maintaining near 20% top-line growth is notoriously difficult.
Yeah, the law of large numbers usually drags that down.
Exactly. It drags that percentage down heavily by this stage in a company's life cycle.
It's incredible execution.
Yeah.
And it's not just backward-looking revenue either. Look at their current remaining performance obligations, the CRPO.
Right, the contracted backlog.
Think of this as the contracted money sitting in the vault that they are mathematically guaranteed to recognize as revenue over the next 12 months. That hit $12.64 billion, up over 22%.
That's a very healthy pipeline.
On top of that, their customer loyalty is ironclad. They reported a 97% renewal rate.
That specific metric is staggering when you consider the broader environment.
Right, because everyone is cutting costs.
Exactly. Corporate IT departments are under intense budget scrutiny right now. Every software contract is being audited for ROI. So a 97% renewal rate means customers view this platform as essential infrastructure, not just discretionary spend.
Absolutely. Yeah. And they aren't just renewing, they're expanding their spending massively. In Q1 alone, they closed 16 deals worth over $5 million in net new annual contract value.
Wow.
Yeah, they had 5 separate deals over $10 million. They have the largest net new logo deal in company history at over $15 million. The underlying business is accelerating. But the strongest piece of the bull case isn't the legacy software. It's artificial intelligence.
Now, that is usually where the narrative gets incredibly murky for SaaS
Oh,
companies.
totally.
I mean, everyone claims to be an AI company right now, but very few are actually monetizing it.
But ServiceNow is monetizing it.
Yeah,
AI is no longer a buzzword on their slide decks. It is fully commercialized. Their Now Assist AI platform is an unmitigated success.
the numbers on that were pretty surprising.
Yeah, on the call, management disclosed that their internal 2026 AI revenue target just got raised from $1 billion to $1.5 billion.
Yeah.
Deals that included 3 or more Now Assist products grew nearly 70% year over year.
Right.
The number of enterprise customers spending over $1 million strictly on Now Assist grew over 130%.
Which tells us they are clearly moving past the pilot or experimentation phase with their massive clients. They're moving into full production.
Exactly. Okay, let's unpack this a bit. CEO Bill McDermott has this vision of ServiceNow becoming the AI operating system for the enterprise.
Right, the central hub.
Yeah, think of it this way. If you look at a modern, massive corporation, the IT environment is like a chaotic football field. You have countless autonomous AI agents. You've got foundational large language models from OpenAI and Google.
Decades-old legacy software system.
Right, and they're all running around making noise.
Right.
ServiceNow is essentially positioning itself as the quarterback. It sits right in the middle. It has the contextual data to orchestrate the plays, tell the individual AI agents what to do, and actually update the central system of record.
So it acts as the workflow orchestration layer, like the connective tissue for everything else.
And it is working. They announced that their own internal deployment of AI agents is already resolving 90% of employee IT requests autonomously.
That's a huge efficiency gain.
It is. So I have to stop here and challenge you on the bear case.
Huh.
With numbers this fundamentally sound, with an autonomous workforce driving incredible internal efficiency, and with a clear line of sight to $1.5 billion in pure AI revenue, how does Wall Street look at this quarter and decide to dump the stock 18%?
Well, what's fascinating here is, to answer that, we have to entirely detach ourselves from Q1.
Great, really?
Yeah, the market reaction you are seeing wasn't actually about the quarter that just ended. It was entirely about the quality and the composition of the forward guidance.
Okay.
Wall Street is a forward-looking discounting mechanism. What have you done for me lately instantly becomes, well, what are you going to do for me tomorrow? And when institutional analysts looked at tomorrow, they saw significant structural cracks.
Even with the guidance raise, I mean, they raised the numbers.
Especially with the guidance raise. Let's start with a major red flag that immediately spooked investors. There was a 75 basis point headwind to Q1 subscription revenue.
Okay, break that down.
During the earnings call, CFO Gina Mastantuono explained that several large on-premise deals in the Middle East were delayed. These contract closures were pushed out due to the ongoing geopolitical unrest in the region.
Now, just to be clear for you listening, we are looking at this purely through the lens of financial mechanics.
Absolutely.
We're strictly reporting on the business impact of these deal delays as stated by the company. We're not taking any political stance on the unrest itself.
Right. The financial mechanic here is what caused the panic, and it requires a quick look at the plumbing of software accounting.
Walk us through it.
So in certain regions, governments and highly regulated industries require sovereign clouds or physical on-premise deployments for intense security reasons.
Right. They don't want their data on public servers.
Exactly. But unlike traditional cloud SaaS software, where revenue is recognized smoothly over the life of a multi-year subscription.
Right. A little bit each month.
Yeah. On-premise software revenue is often legally required to be recognized entirely upfront the exact moment the deal closes.
Oh, I see. So a delay in a cloud deal is just a minor blip, but a delay in an on-premise deal creates massive lumpiness in the quarterly earnings.
That is the core issue. If a massive standard SaaS deal slips by 2 weeks and lands in the next quarter, it barely dents the current quarter's revenue because you were only going to recognize a tiny prorated fraction of it anyway.
Right, makes sense.
But if a massive on-premise deal slips, you lose the entire multi-million-dollar chunk of upfront revenue for that quarter.
Wow.
Now, management did note that a couple of these delayed Middle East deals eventually closed in Q2, but in an environment where investors are already incredibly nervous about macroeconomic stability, any mention of delayed deals due to geopolitics triggers immediate anxiety.
They worry about the health of the broader sales pipeline.
Exactly.
Wait, hold on. You're saying a few delayed on-premise deals in the Middle East erased 18% of a mega-cap company's value. That math simply doesn't add up for me. Wall Street can't be that reactionary. Management still raised their full-year subscription revenue guidance to around $15.75 billion.
Well, it's not just the delayed deals, it is the composition of that guidance raise. This brings us to the second major issue, which is the illusion of the raise.
The illusion.
Yes, ServiceNow did indeed raise that full-year top-line number. However, what they quietly disclosed alongside it was that roughly 125 basis points of this forward growth, meaning 1.25% of it,
Right.
is coming directly from their recent $7.75 billion acquisition of the cybersecurity firm Armis.
Ah, okay, so they didn't generate that extra revenue organically. They essentially bought it.
That is the exact takeaway institutional analysts had. If you strip out the acquired Armis revenue, management did not raise the organic full-year revenue guide at all.
Wow.
Yeah, in the enterprise software world, investors aggressively reward clean, organic beat-and-raise quarters. It proves your core product is indispensable and your internal sales team is executing.
And buying revenue doesn't prove that.
Right. When your top-line growth is visibly padded by multi-billion-dollar acquisitions, the market gets spooked. It suggests your core growth engine might actually be decelerating.
But look at why they bought Armis and why they also just acquired Veza, an identity security firm. From a product perspective, it seems incredibly strategic.
Strategic, sure.
Bill McDermott spent significant time on the call talking about creating an AI defense shield. Think about the enterprise architecture we just talked about.
The quarterback analogy.
Right. As these AI agents start autonomously accessing massive corporate databases and executing complex workflows without human supervision, the security risk explodes.
It's a huge vulnerability.
Yeah. So Armis gives them deep asset visibility across the network. Veza gives them strict identity governance. And ServiceNow provides the action layer to fix vulnerabilities. It's a brilliant, necessary strategic expansion to capture the incoming AI security market. Why on earth is Wall Street punishing them for building a product that the market desperately needs?
Because that strategic expansion is incredibly expensive, and Wall Street is punishing the severe margin destruction that comes with integrating those assets.
Margin destruction.
Yeah, buying a massive $7.75 billion company like Armis isn't just plugging their software into yours. It requires aggressive accounting adjustments, massive operational integration costs, and something called the amortization of intangibles.
Okay, let's break that down for the listener, because that sounds like pure CPA jargon.
Fair enough. When you buy a software company, you aren't just buying physical servers or office chairs. You are buying patents, brand value, and proprietary code.
Right, the intellectual property.
Those are intangible assets. Accounting rules force you to write off the invisible value of those assets over time on your balance sheet, which brutally suppresses your reported profit margins in the short term.
Oh, I see.
And management was very transparent about this cost. Armis is creating a 25 basis point drag, so 0.25%, on subscription gross margin.
Ouch.
It's creating a 75 basis point headwind to operating margins. And most painfully, it is creating a massive 200 basis point drag on free cash flow margin for 2026.
A 200 basis point drag. In plain English, that's a 2% hit to free cash flow. For a company generating $15 billion in revenue, we are talking about hundreds of millions of dollars in expected cash just vanished from the spreadsheet for the year.
And the immediate localized pain in Q2 is even sharper. They guided Q2 operating margins to come in at an unusually low 26.5%.
Wait, what were analysts expecting?
Before the earnings print, Wall Street analysts had modeled expectations north of 30%.
Oh, wow. So that is a massive miss on profitability expectations.
Yes.
Here's where it gets really interesting, though. Management explicitly promised on the call that these margins are going to normalize by 2027. They detailed this entire now-on-now initiative where they are using their own internal AI agents to drive operational efficiencies.
Right, to offset these exact integration costs.
Yeah. Again, isn't Wall Street just being notoriously short-sighted? They are punishing a long-term visionary strategic play because of a two-quarter accounting hangover.
If we connect this to the bigger picture, that assumes the stock was priced fairly to begin with.
Mm-hmm.
The reality of this 18% drop comes down to valuation multiple compression.
Multiple compression.
Yes, you have to look at how ServiceNow was priced before this earnings print. They were trading at over 50 times earnings. They were trading at roughly 6.4 times enterprise value to forward subscription revenue.
Let's translate that EV to forward revenue multiple. That means investors were willing to pay $6.40 today for every $1 of subscription revenue Wall Street hoped the company might make next year.
Correct. That is an incredibly steep premium valuation.
Extremely high.
At that altitude, absolute perfection is priced into the stock. You are priced for flawless organic growth and relentless quarter-over-quarter margin expansion.
So no room for error.
There is zero margin of safety. Analysts at KeyBank, for example, completely downgraded the stock to a sell with a target of $85.
Wow, a complete sell rating.
Why? Because institutional investors simply have zero tolerance for margin dilution at a 6.4x multiple, even if the dilution is for a highly strategic, long-term asset.
Right.
When the growth algorithm gets messy, like when you mix slowing organic growth with inorganic acquisitions and you aggressively compress the cash flow margins.
The valuation multiple mathematically has to compress.
Exactly. That 6.4x multiple violently compressed down to 5.5x in after-hours trading. That multiple compression is the pure math behind an 18% drop.
So the fundamentals of the software are fine, but the math of the stock was highly vulnerable. It was a valuation reset, pure and simple.
Exactly. The company didn't lose 18% of its utility. The stock lost 18% of its premium.
Okay, but Wall Street might be ignoring that exact margin compression because they are entirely missing a massive structural shift hiding in these same Q1 numbers.
Which shift?
There was a data point buried in this report that I think fundamentally changes the long-term thesis for this company, something that goes way beyond a single quarter's integration hangover.
You're pointing toward the shift in the pricing model.
Yes, the paradigm shift. Management disclosed that 50% of their net new business is now coming from non-seat-based pricing models. We are talking about hybrid pricing, consumption tokens, and connector fees.
That is a huge structural evolution for a legacy SaaS company.
It really is, and we need to explore why this matters so much. For the last year, the entire software sector has been operating under an existential cloud of dread regarding something called seat compression.
Right, the idea that AI will replace human users.
Exactly. The fear is simple. Historically, SaaS companies like ServiceNow charge per human user, per seat.
Yeah.
But if ServiceNow's own AI, Now Assist, makes employees so efficient that one person can do the work of three, or if autonomous AI agents replace human IT desk workers entirely,
Then client companies are going to require far fewer human employees.
right, and fewer human employees mathematically means they buy fewer software licenses.
The fear is that by building incredible AI, software companies will effectively cannibalize their own core revenue streams.
And changing that dynamic isn't just flipping a switch. I mean, the entire software industry has relied on per-seat pricing for 2 decades. Changing that plumbing requires ripping up every sales contract, every sales rep quota, and every commission structure in the company.
It is terrifying for a management team to overhaul that.
It's massive. But this Q1 data proves ServiceNow is successfully rewiring their entire monetization engine to survive the AI revolution.
It's a fundamental rewiring of how value is exchanged.
Yeah. Think of the old software model, like charging rent per roommate in an apartment building. If a roommate moves out because a robot now does their chores, the landlord loses a chunk of rent.
Right.
But ServiceNow is successfully transitioning to charging for the actual electricity the apartment uses. Through consumption tokens, as AI does more work and executes more background workflows, ServiceNow gets paid for the usage, the compute power, and the orchestration.
They get paid regardless of whether a human employee or an AI agent triggered the workflow.
Exactly.
And that is the real long-term signal buried in the Q1 data. If you are an investor trying to cut through the noise, you have to separate the short-term accounting from the long-term survival of the business model.
Right.
The 18% drop is largely driven by Armis integration accounting, a high valuation multiple, and the timing of a few geopolitical deals. It's painful.
It's painful.
But the actual signal is that ServiceNow is proving they can monetize AI directly through usage. They're successfully removing the existential threat of seat compression that is haunting the rest of the software sector.
So what does this all mean? If we step back and look at the whole picture, the Q1 contradiction actually makes perfect sense when you separate the underlying business from the stock valuation.
Right.
On one hand, the business is thriving. Subscription growth is near 20%. AI is scaling rapidly into a massive $1.5 billion revenue stream, and their product suite is expanding to secure the entire enterprise workflow landscape.
They are deeply structurally embedded in the operations of the Fortune 500.
But on the other hand, the stock was priced for absolute perfection. And when you introduce messy acquisition accounting, a massive 2% hit to free cash flow, and macro-driven deal delays in the Middle East.
A stock trading at an extreme premium is going to face a painful, violent valuation reset.
It's the classic difference between a great company and a perfectly priced stock. But to wrap up this deep dive, I want to leave you with something completely different to mull over. We spent a lot of time talking about how ServiceNow is building the infrastructure for a global AI economy.
Right.
But look back at those delayed deals in the Middle East for a moment.
Oh, the sovereign cloud issue.
Exactly. Governments and highly regulated industries are increasingly demanding that their AI infrastructure and their data physically reside within their own borders.
Right, they don't want their sensitive workflows processed in a centralized global cloud.
If this trend of sovereign clouds and on-premise AI deployments accelerates due to geopolitical tensions, it raises a massive question.
It challenges the entire premise of global SaaS efficiency.
It really does. So the question you have to ask yourself is this: are we watching the end of the unified global software market?
That's a big question.
As artificial intelligence becomes the central nervous system of governments and corporations, will the cloud shatter into localized regional tech fiefdoms? And if so, how does a global giant like ServiceNow maintain its margins when it has to build custom on-premise AI fortresses for every country it operates in?
Now, that is a structural shift that goes far beyond a single quarter's earnings report.